and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the day trade. We'll also get you expert views as to how should you be really understanding the current momentum in the markets and where are the opportunities that you can keep on your radar for your investments in equities. We'll get you expert views, but first up, a quick check on how the markets are doing at this point in time as we inch closer to the end of the day today. 18,600 still there, 109 points of an uptick, so the markets have been pretty steady. In the last two and a half hours of trade as well. We've seen these levels constantly being held on. 62,893 currently for the Sensex as well, up about 400 odd points or 0.6% in trade as well. But what will be important to see is whether this is translating into the broader market's performance as well. The mid and the small cap 100 indices were maintaining an upside of about 0.4%, and you can see that continuing even now. 130 points of a jump for the Nifty mid cap 100, and the small cap 100 index is up by about 37 odd points. Of course, the Nifty Bank is the star of the day today. The Nifty Bank touched its all-time high levels, 44,355 currently, 337 points of an upside and 0.7% of an uptick. So financial services, PSU banks clearly leading the way for the Nifty Bank. Apart from this, you're seeing momentum continuing in some of the other sectors as well. Autos, FMCG, for example, are up in trade. We're also seeing momentum continue in the consumer space as well, 1.3% uptick. In fact, the day's high for this one. The energy space is slightly up in trade, has been pretty volatile from the day's morning session as well. Financial services, like I pointed out, have been going strong. There was slight sell-off and profit booking taking place. The realty pack is inching towards the day high now, 0.9% of an uptick for this one as well. The PSU banks, like I pointed out, both leading the rally, almost 0.8-0.9% uptick, but right now about 0.6% of a gain. The metals have also shown brightly in today's trading action, 0.9% of an uptick for that one as well. If we look at the top gainers and the loser, laggards in trade right now. But time to welcome our guest on the show. Gautam Baid joins in. He's the equity advisor of Complete Circle Stellar Wealth PMS. Welcome, Gautam, and thank you so much for taking the time out for us. You're joining in from US, so thank you so much for making time for this discussion. Of course, it's a good day to be interacting with you because the Nifty Bank is at an all-time high level. We've been seeing that the Nifty is just about 300 points odd away from its all-time high levels as well. The tide seems to have turned in favor of the Indian equities. Do you think this turn is going to be a long one and we are in for more gains before the year ends?
Actually, the tide for Indian equities turned since 1991. We have been in a secular bull market for the last 32 years. And in the intermittent periods, we keep having small temporary blips. But the long-term trend of Indian equities is onward and upward. There is no doubt in my view regarding that. I think the most heartening aspect of the current market is the broadening of the market and the sharp moves in mid cap and small caps driven by earnings growth. So this is a great market for bottom-up stock pickers. Wherever you see signs of the business improving or bullish management commentary or strong earnings, those stocks in small cap and mid caps are getting very handsomely rewarded. So it's a great time to be a bottom-up stock picker in India.
Absolutely. Now, one other factor that everybody is talking about, while we are seeing this momentum on the upside, is that on a year-to-date basis, we've seen that the FIIs have made a comeback in the Indian equity markets as well. Almost a 2,000 odd crore rupees daily is what we've seen on a month-to-date basis for in this month as well. So how do you see this momentum from the FIIs after they had sold off last year? Going ahead, do you expect the momentum of buying to continue? And with all that's happening around the world, will that sustain is the big question.
So there are three main indicators which any active investor looks at for understanding the direction and momentum of FII flows. The first one is the rupee dollar exchange rate. Second one is the trend in oil prices. And the third one is the interest rate stance of the Federal Reserve in America. So all these three indicators are now playing in India's favor and in the favor of emerging markets in general. The US dollar index has corrected a lot from the peak, although it is showing some signs of resilience recently, but it is still down quite a bit from the peak. Oil prices are trading near 52-week lows, and the Federal Reserve is also nearing the end of their interest rate tightening cycle. So all the three factors are playing in emerging markets and in India's favor. And I think once FIs return to India, we have to understand that in the last 1.5 years, when they sold $35 billion of Indian equities, we still have the Nifty and Sensex at all-time highs now. Just imagine what's going to happen once those FIs return. that is when we'll see a very strong momentum in the high quality small cap, mid cap, and large cap stocks, because when the foreigners invest, they focus primarily on the quality of the business. They don't go into micro caps and cyclicals and commodities. They go for very strong secular earnings growth stocks. That is where we should position our portfolios.
Right. You pointed that, of course, that the Indian equity markets are also buoyed by the kind of strong fundamentals that we've been seeing in the earnings as well. This time around, the most of the interactions that I've had with experts, they believe that large part of the earnings so far have actually met the expectations or have actually come in better than expectations. What have you made sense of the earnings season so far, and what does it augur, for the Indian markets going forward from here?
Sure. So this was one of the most eventful earnings season in a very long time, and I think sectoral leadership for the next 2 years has been very clearly established in this particular earnings season. So I think lenders as a basket, including NBFCs, small finance banks, microfinance, private sector banks, they have shown very strong performance, and the performance is expected to continue for the foreseeable future. Along with lenders, capital goods, cables and wires, and hospitals also had a very good quarter. So these are the particular areas where strong earnings were witnessed. I think two areas where you're seeing a lot of improvement happening is in autos and FMCG, because after a long time, we actually got to hear from managements of these two sectors that because of the fall in commodity prices, the margins have bottomed out, and many of the managements are now talking about gross margin improvement. Also, we should keep in mind that we have national elections next year, and 6 months before and 6 months after any national elections, rural facing companies, especially from FMCG and autos, they tend to do pretty well. I think one of the biggest disappointments of the earnings season was IT, and that was to be expected because markets discount the worst upfront. So markets are discounting the slowdown in the Western world. So IT has reported a disappointing quarter, but the long-term trend of outsourcing from India remains intact. I think these sharp falls, which we get every few years, they should be capitalized on to actually build positions in some very high quality IT names.
Okay, but you did point out, consumption-oriented stocks, domestic-focused stocks are likely to do better ahead and, around the elections as well. But which are the themes that you believe may outperform going forward from here in the markets?
So rural India does well. The microfinance companies, by definition, will do very well. And microfinance industry right now is experiencing a very strong tailwind driven by the positive regulatory change brought by the RBI last year. So what the RBI did last year was they removed the 10% interest rate cap for microfinance companies, and they also allowed microfinance companies to have 25% of their loan book in non-microfinance sectors. So the total addressable market size for microfinance companies has gone up, and the interest rate cap is also gone. So now they can price risk appropriately. So microfinance is one sector which we are very bullish on. We are playing it through one of the leading microfinance companies of India and some small finance banks in our PMS. Alongside microfinance, we are also very bullish on electronics manufacturing services (EMS).
Okay.
Because in any sectoral bull market, the leaders will always come from sectors having the fastest top line growth. So if you look at this industry as a whole, the EMS industry is expected to grow at 30-40% at an aggregate level for the next 3 to 4 years. So this is, I think, where you'll see sectoral leadership for the next few years.
Okay, so electronic manufacturing, this space is definitely that you should watch out for in case you're looking to generate alpha in the markets and outperform the markets going forward. But like you also earlier pointed out, that the Indian markets, despite the FII outflow that we saw over the last 1.5 years, were still maintaining their leadership among the global markets. Will that outperformance of Indian markets continue going forward from here? Now that the debt deal is done, some of the uncertainties you also pointed out are now largely behind us. US Fed is ending the rate hike cycle, so some of those nervousness is already easing out. Looking at that, can the Indian markets maintain that leadership?
The answer to that lies in the domestic SIP flows, Sakshi. So as long as the domestic SIP flows remain very robust, we'll be less affected by what the FIs are doing. But to answer, the first part of your question, see, in the stock markets, there will always be something to worry about at all times. Right now, markets may enjoy a relief rally for a few days because of the debt ceiling issue getting resolved. After that, they will again start focusing on the US interest rate because the Fed fund futures are forecasting a 25 bips interest rate increase again next month. That will take the US interest rates to 5.25%. And after that, the markets will get back to worrying about the high interest rates and the high levels of debt in the developed world. So, the key to investing success over a long period of time is to ignore the worries of the world long enough to let your stock price, your stocks and your businesses and your investment thesis play out. That is how you make money in the market.
Okay. Would you say that you have enough confidence that the worst is definitely behind us, because inflation may be down, but globally there's still a lot of concerns, a lot of moving parts. The war is not over yet, and we do not know where the next bazooka is really coming in from. So, would you be confident enough to say that the worst may be behind us?
So no one knows where the next bazooka or the next big bomb will drop in the market from, but I can give you a fair sense of the timing when it can happen. So the federal futures right now are forecasting the Federal Reserve to cut interest rates in the next 3 to 4 months. Now, history teaches us that the Federal Reserve cuts interest rates when the financial system breaks or there's a big stock market crash. So that's a reasonable estimate of the timing of the big fall in the Western markets sometime in the next 3 to 4 months. That is, if you believe the Fed fund futures are accurate, and generally in the past they have been pretty accurate in forecasting these kind of events. So, move forward, but with caution and stick with quality. So, and plus, you also have the uncertainty associated with the national elections next year. Irrespective of the level of confidence which one may have on the outcome, still we have seen in the past, the unpredictable and the unfathomable events keep happening in the stock market. So be prudently diversified, have a focus on quality, and stick with the strongest franchises. Whether you're investing in small cap, mid cap, or large cap, stay with the sector leaders and stay with managements of good integrity.
So, how do you select a stock for your own portfolios, for the PMS that you run? Help us, our larger base of our viewers, to understand that. What is an ideal way to select a stock?
So, Sakshi, at Complete Circle Stellar Wealth PMS, there are two key pillars of our investment philosophy: variant perception and long-term structural trends. Variant perception refers to situations where you get return on capital employed (ROC) expansion coupled with earnings growth, you get valuation re-rating, and you end up with multi-baggers. And variant perception comes from having a short-term to medium-term differentiated view on a particular business. And there are multiple triggers for variant perception. Number one, product mix change into a higher margin category. Number two, deleveraging, because as debt goes down, since debt is a part of capital employed, your ROC goes up. Plus, you save on the interest cost, so your net profit also goes up. Number three is working capital improvement, because working capital is a part of capital employed. So if you're able to negotiate better terms of trade with your stakeholders, your working capital goes down and your ROC goes up. Number four is positive regulatory change. So I mentioned about the positive RBI regulatory change for the microfinance sector. So that's another source for variant perception. Number five is industry cycle shift. So a couple of years back, the residential real estate cycle in India turned around after more than a decade, and we have had many multi-baggers coming from the building material space in India since then. And number six is improvement in asset turns. You can get this information from managements on conference calls, and you can ask them what is the expected turnover of the new fixed asset capacity. So that's another source for variant perception. And finally, we have got corporate actions like demergers, merger arbitrage, and promoter management change. These three special situations form part of the special situations portion in our PMS. Second part, which I referred to, was long-term structural trends.
Yeah.
These are found in industries with a very favorable structure. They're organized like a monopoly or a duopoly or an oligopoly at best, and they are experiencing some form of an industry tailwind. So you have visibility for many years ahead. And there are multiple structural growth plays in the Indian stock market today, namely affordable housing, fintech, specialty chemicals with critical application, digital transformation, contract manufacturing, including CDMO, CRAMS, and EMS. Multiple mega trends are in place, and these when the majority of the portfolio is in long-term structural trends, you get that long-term compounding, and a portion of the portfolio is in variant perception to create that alpha for our PMS clients.
Okay, understood that as well. But I had to also ask you about some of the new age technology companies. How do you really look at this space? Because again, there is this whole question about how do you value these companies, and they are yet to turn profitable. At the same time, investors who've been using these services on a day-to-day basis, they fail to understand that what exactly should be their own metric to understand the fundamentals of these companies as well. How would you perceive this whole space, and is there anything that you would want to suggest to all our viewers who have been holding on to the positions waiting for some kind of turnaround to happen?
See, in our PMS, the way we deal with difficult or challenging investment situation is to avoid them altogether. So, in investing, the degree of difficulty does not count. Basically, the simpler the thesis, the higher the probability of the investment actually working out. And in many of these new age tech companies which you're referring to, you'll get earnings many years out into the future. Whereas in our PMS, we like to invest in businesses where the earnings are already on the table, where the businesses already have a decade-long track record of profitability, cash flow, and balance sheet strength, and good capital allocation. So, I think the best predictor of the future is the past track record. So that is how basically we approach investing in stocks in our PMS.
All right, understood that. Well, thank you so much, Gautam. Great speaking with you and seeking all those insights about the markets and the way investors should be approaching their investments in equities at this point. Always a pleasure having you with us on Business Today TV. Thank you so much for speaking to us. Let's look at how the markets are also looking at this point in time, about 10 minutes away from the markets closing. We're still up, by the way, but slight selling that you can see at the top level. So 18,600 has been breached on the downside, 62,838 currently for the Sensex, 336 points up, still remaining. The markets have been, maintaining a narrow range but steady at this point, 5% of an uptick. But will this continue for the rest of the week is the big question now, and we shall continue to take our, watch over how the markets move from here on, so that you can take the wisest decisions for your investments in equities. Until then, do stay tuned on to Business Today TV.